Hi, I'm Takoa De Silva with Sprott Global Resource Investments, and I'm sitting down here today once again with Mr. Rick Rule, Chairman of Sprott US Holdings. Rick, as always, good to see you.
Thank you, Takoa.
So I'd like to ask you here today about general market conditions for resource and mining equities. And to start out with, one of the things that I love asking you most about in terms of this discussion is the cost of money, the cost of capital, as you put it. When you look vertically at the resource space, at exploration, development stage, producers and major producers, what sense of the cost of money are you picking up here from the market today?
Well, the cost of capital by historic standards is very high. As a capital allocator, that is a check writer, those are good conditions for me. I know that sounds odd, but I'm not a capital consumer. In other words, I'm not a mining company. I'm a capital provider, that is an investor. And the fact that the cost of capital is high is something that suits me. Now, that makes me sort of perverse among most investors. Most investors want higher share prices for some odd reason. I'm a buyer, so I like bargains, I like sales. To say that I'm in tall cotton would be an understatement. These are wonderful, wonderful times. Your cost of capital question is interesting, however. As an aside, and perhaps a good way to begin this discussion, I note that most analysts in the gold space are using a 5% discount rate as the starting point on net present value discussions. That's an interesting number because the universal cost of capital for below investment grade issuers, that is for most mining companies in the world, is 15%. So using a 5% discount rate when your development debt is costing you 15% is an interesting starting point. And that's the sort of thing that investors need to ask themselves before they commit funds to the sector.
Mm-hmm. So again, looking vertically, where do you see the most attractive opportunities? And for the viewer vertically, we're looking exploration, development, producing companies.
I need to add a disclaimer to that, Takoa. I'm old, experienced, and rich. And the circumstance that's appropriate to me, I'm also patient. The circumstance that's appropriate to me might not be appropriate to everybody that's listening to this video. So I would suggest that they ask themselves the same question before they listen to their answer. Having given you that disclaimer, I'm allocating my own capital in the mining business 3 places right now. I'm allocating capital in the near term to merger and acquisition candidates. We believe that there are lots of them, and we believe that the M&A space has 2 or 2.5 years to run. While the premiums that I expect to extract from that won't be high, I think they'll be frequent, and I think the risks will be low. So I think it'll be a wonderful place to be, and I'm committing a sizable amount of personal capital in that space. That information, by the way, will be available to the Sprott brokers and available to Sprott clients. The second place that I'm allocating capital, my own capital, is to the royalty and streaming companies. The royalty and streaming companies have outperformed other companies in the space, both in terms of their operating performance, but also in terms of their equity market performance. And I think that's for a real reason. They have good operating margins and they don't have sustaining capital expenses. What I think the market misses in terms of the royalty and streaming companies going forwards is that royalty and streaming is an important part of mine finance. And I think that the royalty and streaming companies have the ability in the next 5 to 10 years to add substantially to their asset base as the percentage of capital, construction capital, contributed by royalty and stream sales increases. So I think that the sector will grow faster than most of my competitors believe it will grow. My true love, of course, and the reason that I became rich as I became old, is my fascination for exploration. I have probably a unique ability to be both patient and risk tolerant. And the consequence of that is that I'm personally suited to being a speculator in exploration. I can go through a couple very dry years in search of an extraordinarily good one. And the part of the exploration business which attracts me the most are the prospect generators, the people who understand that exploration is a knowledge business, not an asset-intensive business. This course of action, this method of speculation has treated me really extraordinarily well in a statistical sense in the last 40 years. given that there's a high probability that in future cycles I'll be less active than I am in this cycle, I'm looking forward to going out with a bang. And I suspect that of the three strategies, the one that I will enjoy the highest return on capital employed in, but also assume the most risk in, will be the prospect generators.
Mm-hmm. So, Rick, we're sitting down here in late 2018, going into October. What we've seen over the last couple months are just increasing weakness in just about every segment of the resource space. And so the non-income producing companies, the exploration companies, the prospect generators, and even the development stage companies, it looks like you can start getting things at a discount to what they're worth, or you get some things for free in some instances. So how do you view that segment from a standpoint of preparing your appetite to participate in those companies that are non-income producing, that need continuous infusion of money?
That's a great question. Doug Casey describes it as the falling safe syndrome. It might be attractive, but if somebody's dropped a safe from the 35th floor and you stick out your arms on the 18th floor, rather than a safe, you end up with broken arms. So it's certainly an appropriate question. The truth is that I would start by saying that the most constant thing I've observed in my career is that bear markets are sales. Bear markets are much less risky than bull markets. You have much less risk to yourself, but you also have less risk starting when assets are reasonably priced as opposed to overpriced. Going back to the question, when you are buying a company that has capital needs but no capital sources, what you really need to be willing to do is ask yourself if you would be willing to participate in a financing at a lower price at a later date because you like the quality of the management team and the assets. If you aren't willing to answer that question with a yes, you shouldn't make the first purchase. Now, Warren Buffett famously hates mining stocks. But Warren Buffett said something that was absolutely, well, he said many things that were brilliant, but he said a couple things about stock selection that I think are appropriate to your question. The first thing he said is that you shouldn't buy a share in a company where if you had the means, you wouldn't buy the entire company at the same price per share that you paid for that share. And he also said that you shouldn't buy a share if you wouldn't be delighted to see it 30% cheaper. In other words, the price fall by 30% in a month. In other words, if you don't have the courage of your convictions, enough courage that you wouldn't be delighted to see the share price fall by 30%, you shouldn't make the first purchase. Now, the truth is, Tekoa, in a 40-year career, I've tested that thesis probably 15 or 20 times. And every time that thesis was tested, it tested me too. But more times than not, responding to that test has paid off for me very well. In other words, if a stock I thought was worth $1 and I bought it for $1 and a month later it was at 70 cents, you retest your premise. And if you thought it was worthwhile at $1, you either made a mistake or you better buy more at 70 cents. My favorite story, of course, around that was Paladin, where I bought some stock at 10 cents and watched it fall to a penny. When you are enjoying, if that's the right phrase, 90% loss in your portfolio, there is no such word as hold. You either buy or sell. Fortunately for me, I had the courage to buy, and the consequence of that is that the stock ran to $10. A dramatic example, but I think one that illustrates the point.
Mm-hmm. So things that may be going on in the background, such as general equity market conditions, the interest rates set by a central bank, are things like that background noise? Should they be paid attention to?
I don't think they're background noise, but they're less important than the fundamentals. Remember that for an investor and for many speculators, the stock market is merely a market of stocks. It's a facility. It's not a source of truth. It's a source of information. And so things that go on with an individual issue are more important than the broad context of the markets around that issue. That isn't to say that if we had a liquidity-driven crunch, and the stock markets declined, that gold stocks wouldn't decline because gold stocks are stocks. But you need to, I think, as an investor and speculator, have a sense of value before you worry too much about price. We talked earlier in this interview that a $1 stock, if you know something about what it's worth, is much more attractive at 70 cents than it was at a dollar. And I think when you view the broad context, you need to view it in terms of your acquisition cost and disposition cost, but you need to pay more attention to the value of the company, and you need to worry about the price after you've determined an estimate of its value.
Mm-hmm. So you referenced just a bit earlier M&As, and we had a discussion on that viewers can watch. They can visit our channel for a link to that. But prospect generators, that's been a segment of the resource space that you've talked about a lot as being your favorite in terms of exploration finance. How would you characterize that segment now in terms of price, value, what you see for opportunity?
Unknown, unloved, unwanted, perfect. Perfect. The setup for prospect generators is probably the best in my career, in the sense that most people don't know what they are, first of all, so there's no competition from most investors. Investment bankers hate them because they raise money from other mining companies rather than from underwritten offerings. So there's no research from the sell side because they never get to do any underwritings to support them. At the same time, 20 years of underinvestment and malinvestment in exploration has made a circumstance where the major mining companies, the mid-tier mining companies, and the intermediate mining companies are all crowding back into the exploration space, having laid off their exploration staffs. Mm-hmm. So all of a sudden, the prospect generators, which are unknown and unloved, have customers flocking to them. A circumstance where your business gets better and better and your share price gets worse and worse is a speculator's dream, and that's the circumstance that confronts us right now.
And that's an interesting point, because fundamentally you're anecdotally having some experiences where you see interest coming in sort of at the top level for the prospect generators and contrasted against the absolute lack of interest on behalf of the investment community.
Correct. I'll give you an illustration. I was at a party given by a very famous mining entrepreneur this last March. He shall remain unnamed. And similarly, the CEO of a major multinational mining company, who will also remain unnamed, came across the room to where I was sitting and sat down and said, "Rick, you have me right where you want me. The board has said that we need to increase emphasis on exploration, but we've de-emphasized exploration for 10 years. Our pipeline is empty and we're understaffed." That is the best endorsement for prospect generation that could possibly be given.
Mm-hmm. And I've heard you say before that with a gold mine, you can't sprinkle gold nuggets at the bottom of the mine and grow more gold. So it's a liquidating business. So to replace those reserves, you have to go out and buy another deposit.
Or explore for it. That's a very important thing, Takoa. Many securities analysts look at the mining business perversely on a price earnings basis, suggesting that those earnings are perpetual, like a bakery's would be. The truth is that every day you mine, your business gets smaller. If you aren't replenishing the business, you're liquidating. A mine is a bond. It's a variable bond, but that's all it is.
Mm-hmm. So majors participating with the prospect generators, what do you see as the most likely fit? Joint venture, special partnerships, or acquisitions outright?
The one that I see as the best fit is probably strategic joint ventures, where a major may or may not take an equity interest in the prospect generator, and then joint venture generative exploration, where the prospect generator uses its expertise and the major mining company doesn't take on the overhead, with the major mining company having the ability on preset terms to joint venture any discoveries that come out of the exploration. What that means for the major mining companies is that they don't have to staff up. They don't have to incur the overhead associated with a different style of exploration. It also means that if the exploration isn't as lucrative as they'd hoped, they only lose half their money, because as an example, they can sell their shares in the junior rather than write off the total exploration expenditure. So that's the type of transaction that we prefer to see. Most majors don't like to do generative joint ventures yet, although we see them migrating to that. What the majors really want is for a prospect generator to have advanced the project on their own capital to the point in time where it's drill ready. And the major can come in for, say, $1 million, put 5 or 6 holes into it, and get at least a near-term yes or no. So the ability of prospect generators to turn drill-ready targets is very, very, very high right now.
Mm-hmm. All right, well, Rick, do you think there are any questions we may have not covered on the general condition right now for resource equities?
Hundreds, of course, but I would prefer that your listeners forwarded those questions to you, to either you or I, at contacts@sprottglobal.com, and we'll attempt to answer those questions on a bespoke basis.
Mm-hmm. All right, well, Rick Rule, Chairman of Sprott US Holdings, thanks for sharing your comments with us.
Pleasure. Thank you, Takoa.